Hi student, welcome to another session of Manifested Online Classes. So in this class, I want us to continue with the topic number 1, and that is accounting for asset and liabilities. And in this session, I want us to look on the subtopic accounting for leases under IFRS 16. So as far as this particular topic is concerned, we're going to look on a number of issues, or basically we're going to discuss a number of issues. One, we're going to define what is a lease. Number 2, we are going to look on the various types of leases, or various ways in terms of how leases are classified under IFRS 16. And then from there, we also look on how leases are accounted for by the various parties in a lease, because in a lease, we have a number of parties, actually 2 parties. We have the owner of the asset, who is called the lessor, and then we have the other party who has been given the right to use the asset and who is called the lessee. So therefore, those are majorly some of the issues we are going to discuss as far as this particular topic is concerned. So to start with, I want us to define what is a lease. And basically when we talk about a lease, this refers now to a contract, or basically part of the contract which conveys, or basically which gives the right to use an asset to another person for a specific period of time in return of some consideration, or in payment of a consideration which is known as the minimum lease rental. So therefore, it is that particular contract whereby one of the parties will be given now the right to do what? To use the asset for a specific period of time in return of some periodical payment. So therefore, here we can say that a lease is a contract Yes, so therefore in this case we are saying that when talk about a lease, basically we are saying that this is a contract, or basically part of the contract that conveys, or basically that gives the right to use an asset for a specific period of time in return of some periodical payment, in some or in return of some periodical payment which is known as the minimum lease rental. So therefore, it is basically that particular contract whereby the owner of the asset will be able to give the right to another person to use an asset for a given period of time in return of some periodical payment. And basically we are saying that those periodical payments, we refer to them as the minimum lease rentals. In very simple terms, when talk about the minimum lease rentals, we are talking of the rent now which is supposed to be paid to the person who has been conferred, or basically who has been given the right to do what? To use an asset for a specific period of time. And therefore, it is important to note that in a lease contract, basically we have 2 parties. We have the owner of the asset, who in other terms we refer to as the lessor, and then we have now the person who has been given, or who has been conferred the right now to use what? The right to use an asset. Therefore, we can say here that in a lease, we have 2 parties. So we can say that there are 2 parties. There are 2 parties involved in this contract. And those 2 parties include who? Number 1, we have the person who owns the asset, the owner of the asset. And basically the owner of the asset, we refer to this as the lessor. And then number 2, we have the person who has been conferred, or basically given the right to use an asset, and basically that particular person is called the lessee. The lessee. So therefore, the owner of the asset is called the lessor, and basically this is a person who will have conferred, who will have given the right to use an asset to another person who is called the lessee. Now, in this particular case, we have various ways in terms of how leases are classified in accordance with this particular standard here, that is IFRS IFRS 16. So number 1, we have something called a finance lease. Number 2, we have something called an operating lease, and then we have something called a short-term lease. So therefore, we can look on the types of leases, or basically the various ways in terms of how leases are classified, types of leases. Number one, we have what we refer to as a finance lease, a finance lease. Some books refer to this as a capital lease, lease. And number two, we have what we refer as an operating lease, lease. And then number three, we have what we refer as the short term. The short term what? Lease. So therefore, leases are classified into those three what? Categories. Now, first of all, when talk about a finance or basically a capital lease, we say that these are particular leases which transfers substantially all the risk and rewards associated with the asset to the person who is called the lessee, to the person who is called the lessee. So therefore, that particular lease there, the risk and also the rewards associated with the asset will be transferred to the person who is called the lessee. So therefore, we can say that a finance lease, which is also known as a capital lease, known as a capital lease, we are saying that this is a lease. This is a lease which substantially transfers all the risks and rewards associated with the asset to the lessee, So meaning that this particular type of the lease here will transfer all the risk and rewards associated with the asset to the person who has leased the asset. Basically, what that means is that if, for example, you lease an asset from the owner, any benefit or basically any reward which is associated with that particular building, for example, the rent which is being generated by that particular building will have now to be collected by you as the lessee. And number two, the risk associated with that particular building will also be transferred to you. It basically means that you have the responsibility to ensure that particular building, because if something happened to that particular building, like the building is damaged and something like that, then you have the responsibility to do what? To repair that particular building. So that's why we are saying you have the responsibility to ensure that the building is actually what? Is actually insured. So that in this case, we say that the risk and also the rewards associated with the asset are transferred now to the person who is called the lessee. So number two, we have the other type of the lease, and that is operating lease. Operating lease. So when talk about an operating lease, this is actually defined to be any other lease. This is defined to be any other lease other than finance what it is. In other terms, what that means that under finance or basically under the capital lease, the reward and also the risk which are associated with the asset are not transferred to the lessee. So therefore, we can say that this is any other lease Yes, so therefore, in this case, we are saying that this is any other lease other than what? The finance or basically the capital what? Lease. And therefore, in this case, we have said that the risk and also the rewards which are associated with the asset are not transferred now to the person who is called the lessee. And then from there, we have the last type of the lease, which is called the short-term lease. The short-term lease. When talk about the short-term lease, this refers to any lease whose lease term basically do not exceed 1 year or do not exceed 12 months. When talk about the term of the lease, we are talking of the period of time when the lessee has been given the right to use the asset. So mean that if you lease an asset from the owner and the agreement is that you should use that asset for a period of time which does not exceed 1 year or basically 12 months, then we refer to that as what? As a short-term what? Lease. So therefore, you can say that this is a lease whose lease term does not exceed 1 year. does not exceed what? 1 year, or basically does not exceed what? 12 months. But the two main classification of leases under this particular standard here, that is IFRS 16, is what IFRS the finance lease or and also what IFRS operating what. It is so mean that for accounting purpose, the two main ways in terms of how leases are classified is the capital or basically what? The finance what it is. So therefore, that is the first thing you need to know. You need to know what is a lease, which you have said is basically that particular contract, whereby the owner of the asset will be able to confer, will be able to give the right to use an asset to a person who is called the lessee, and basically the lessee is supposed to pay some periodical payment, which we have referred to as what? The minimum lease rentals. Equally, we have said in a lease contract, we have two parties. We have the owner of the asset, who is called the lessor, and then we have the person who has been conferred the right to use the asset, who is called the lessee. And then in this case, equally, we have said that leases are basically classified in three main what? Categories. So actually, we have said we have two main categories, the finance lease, and then from there we have what? The operating lease. Then from there, I want us to look on how leases are accounted for by the person who is called the lessee. So by the person who is called the lessee, so we can look on what we refer as accounting for leases. Accounting for leases by the lessee. By the lessee. So first of all, who is the lessee? The lessee in this case, we have said, is that particular party, is that particular person who has been conferred the right to do what? To use the asset for a specific period of time, and then he is supposed to do what? To pay some periodical payment. Now, one of the important points to note here, as far as accounting for leases by the lessee is concerned, is that the lessee, in accordance with IFRS 16, should not classify the lease as an operating lease or a finance lease. So basically what that means, that classification of the lease as an operating or finance lease, it only applies to the owner of the asset. The owner of the asset is who? Is the lessor. So therefore, that is the first important point, that the lessee should not classify the lease, a lease contract as an operating or the finance lease. The finance what? It is, and basically I've said that this is a requirement of IFRS 16. It is also important maybe to note at this point that IFRS 16 is basically a new standard which was issued to replace the old standard on leases. The old standard on leases was IS 17, International Accounting Standard number 17, and that particular standard had given the lessee the option to classify the lease as an operating or basically what? Finance lease. And therefore, what most of the companies were doing after leasing asset, most of the company were accounting for those particular leases as operating leases. So what that means is that most of the companies were avoiding showing liabilities in their books of accounts by accounting for the leases as what? As the finance leases. Because once a company leases an asset for a long period of time, the company should be able to show the liability which will be in form of the lease rentals to be paid over the lease term. But what I'm saying is that under IS 17, most of the companies were avoiding that, showing liabilities in their balance sheet, and therefore they were classifying for all leases as operating what? Leases, whereby companies were only accounting for the lease rentals which was paid in a certain financial year as an expense. But now, this particular standard here, IFRS 16, considered that as a limitation associated with IS 17, and basically now IFRS 16 prohibit now the lessee from classifying the lease as an operating or what? A finance lease. And therefore, once a company or basically an entity leases an asset, what that particular entity should recognize in its books of account are two items. Are two what? Items. Number one, we have something called the lease liability, and number two, we have something called the right of use what? Asset. So therefore, we can say that on initial recognition, on initial recognition, the lessee should recognize, the lessee should recognize or basically record number one, right of use asset, right of use asset, and number two, something called the lease liability. Something called the lease what? Liability. So these are the two items which now the lessee is expected to initially record in his books of account once now the lessee has leased an asset. Has leased what? An asset. Therefore, in this particular case, what you're going to look, we are going to, or basically we're going to cover, we're going to look on how we determine these two items. How do we determine the right of use asset? And number two, how do we determine the lease what? Liability. So I think we can start by looking on how we determine what we refer as the lease liability. Lease liability. So the lease liability, essentially, this represents the present value of the minimum lease rentals which now the lessee is expected to pay. So basically what that means is that if, for example, you lease an asset and you lease that asset for the next 5 years, then there is the minimum lease rentals you should be paying annually. Remember, in this case, you have said the minimum lease rentals is the rent to be paid on annual what? Basis. So therefore, for you to be able to determine the lease liability, what you do, you have to discount, or basically you have to get the present value of the minimum lease rentals you are going to pay over the lease what? Term. And therefore, in this case, we can say that the lease liability, this is equal to present value of minimum lease rentals, not paid at the inception date, of the lease, discounted using the interest rate implicit in the lease. Interest rate implicit in the lease. Implicit in what? In the lease. So therefore, for us to be able to determine the lease liability, what we do is that we get the present value of the minimum lease rentals, which is not paid at the inception date of the lease. So basically what that means that in getting that particular present value of the minimum lease rentals, we do not take into account, we do not include any minimum lease rentals which is paid at the inception date of the lease. Like maybe we take a small illustration here. We are told that a company leased an asset, and that company is supposed to pay a minimum lease rentals. Remember, in this case, we have said that when we talk about the minimum lease rentals, we are talking of the rent now to be paid by the company on annual what? Basis. So we assume that that company is supposed to pay maybe an amount of 100,000, and you're told that this particular rent is payable in advance. Is payable in what? In advance. So being payable in advance, that means that the rent for each financial year is supposed to be paid at the start of each year. At the start of what? Each year. And also we assume that we are told that the lease term, so in this case when we talk about the lease term, basically we are talking of the period of the lease. The lease term maybe we are told are 4 years. Are 4 years. Also, in this case, the examiner will have given you something called the interest rate implicit in the lease. So when we talk about the interest rate implicit in the lease, this is the rate now which you should use for discounting purpose, because in discounting, in getting the present value, you must be having an R. So R is now what? The interest rate implicit in what? In the lease. So let's assume that we are told that the interest rate the interest rate implicit in the lease, implicit in the lease, maybe is 10%. Is 10 what? Is 10%. Now, in this case, how do we determine the lease liability? How do we determine the lease liability? So we are saying the lease liability will be equal to the present value of the minimum lease rentals not paid at the inception date of the lease. In this case, when we talk about the inception date of the lease, we are talking of the date when the lease commenced. We are talking of the date when the lease commenced. So in this case, maybe we can have a schedule here, a certain schedule. So we are saying our lease here is for how many years? For 4 years. So this will be year 1, year 2, year 3, year 4. So how much rent is supposed to be paid annually? So we know that the rent to be paid annually here is 100,000, and basically you say that this should be paid at the start of each year. So what that means is that the first rent will be paid at the start of year 1. Basically the start of year 1 we refer to that as time 0. The other rent will be paid at the start of year 2. The other rent will be paid at the start of year 3. And the other rent now will be paid at the start of year what? Year 4. So to determine the lease liability here, we are saying that this will be equal to the present value of the minimum lease rentals not paid at the inception date. So not paid at the inception date. So in this case, when we talk about the lease, minimum lease rentals not paid at the inception date of the lease, we are talking of the rent now which was paid at the start of year 2, at the start of year 3, at the start of year 4, because this particular amount here was paid at the inception date. At the inception what? A date. So therefore, let's determine the lease liability, which will be equal to 100,000, which is now the minimum lease rentals. And then what we need to do, we need to discount that. So how do we discount this? We discount this by multiplying that with the present value, interest factor of annuity, at which rate? So this 10% will be our R at the rate of 10%. And then in this case, we are discounting the rent which was paid at the start of year 2, at the start of year 3, and also at the start of year 4. So therefore here we consider rent for how many period? 3 periods, or basically yes, 3 periods. So therefore here our N will not be 4, but rather our N will be what? Will be 3 years. Because in this case we are saying this particular lease rentals which was paid at the inception date of the lease does not form part of the liability. So therefore we take 100,000, and how do we compute that? To compute this, there is a formula which we apply here. We take what? We take 1 minus 1 plus R. Our R in this case is 10%, so this will be 1.1 raised to power negative 3, and then we divide that with R, which is 0.1. So whatever we get here, this is now what we refer as the lease liability. Liability. So therefore, it is important here to note that the lease liability, basically this is the present value of the minimum lease rentals, which is not paid at the inception date of the lease, because the amount which has already been paid at the inception date of the lease, that does not form part of the liability. So and then we discount that using what we refer as a interest rate implicit in what? In the lease. And then once we have determined that particular lease liability, then what we should do, we should be able to amortize that. We should be able to do what? To amortize that, because now whatever you are going to get here as the lease liability, it basically represent the present value of what now the lessee is expected to pay over the lease term. So basically what that means that at the end of the lease, then the lease liability should be what? Should be 0. But we are going to look on how we do that particular amortization, specifically when looking on an illustration what? A question. So then from there, we can proceed and look on how do we determine the other items there. Remember in our case here, we have looked on how we determine the lease liability. So next I want us we look on how we measure, how we determine the value of what? of the right of use asset. So let's look on how we determine that. That is the right of use asset. So we have right of use asset, right of use, abbreviated as ROU, right of use asset, right of use asset. So to determine this, basically we add like 3 items. We add 3 items. One, we take the what? The present value of what we refer as the minimum lease rentals, present value of minimum lease rentals at inception date of the lease, inception date of the lease, of lease, and then now to this we add payment. So to that we add what? The payment made before all at the inception date of the lease. So when talk about this payment made before or at the inception date of the lease, we are talking of any rent which was paid at the date when the lease commenced. For example, from this particular small illustration which I've given you here, so this particular amount of 100,000, this is a payment which was made at the inception date of the lease. So take into account that. And then to this we also add any initial direct cost, initial direct cost, e.g. what we refer as the legal cost, the legal cost. So in this case, when we talk about the legal cost, anytime as a company or as an entity you lease an asset from the owner, then you must have a lease agreement drafted by you, or basically you must enter into a lease what? Agreement. So that particular lease agreement will be drafted by a lawyer who definitely will have to charge you a fee. So that particular fee which will be charged by your lawyer, we refer to it as what? As a legal cost, which is basically an initial direct cost which is associated with what? With the lease. So therefore what we do, we add all this, and basically whatever you get here is the amount for initial recognition of what we refer as the right of use what? Asset. And then once this particular value has been determined there for the right of use asset, then subsequently it must be depreciated on a straight line what? Basis. So therefore you can say that the right of use asset must then be depreciated, Yes, so basically what you're saying is that this right of use asset must then be depreciated at the shorter of 2 period. At the shorter of 2 period, one, what we refer as the lease term, and what we refer as the economic life of the asset. So like assuming you are told that the lease term, or basically the term of the lease, 4 years, and then you're told that the economic life of the asset are 5 years, So therefore, you depreciate this right of use asset at the shorter of these 2 periods. You take the period which is shorter out of the 2 periods. So in our case, the period which is shorter, 4 years. So what you do, you take the value you have determined here, and then you divide that with 4 years. Whatever you are going to get now is the depreciation per word, per annum, of which that particular depreciation should be recognized by the lessee here in the income statement as what? As an expense. As what? As an expense. So therefore, it is important to note that according to this particular standard here, IFRS 16, it prohibits the lessee from classifying the lease as a finance or an operating lease. This standard requires that at the inception date of the lease, once an entity or basically a company leases an asset from the owner, that company should recognize two items in the books of account. One is what we refer as the lease liability, which you have said is equal to the present value of the minimum lease rentals not paid at the inception date of the lease. And then we have said that that lease liability should be amortized over the lease term. And two, the lessee should be able to recognize something called what? The right of use what? asset. The right of use asset is basically determined by adding these three items: the present value of the minimum lease rentals at the inception date of the lease, plus any payment made before or at the inception date of the lease, plus any initial direct cost associated with the lease. And then you have said that that right of use asset should be depreciated at the shorter of two period. That is now the lease term and also the economic life of of the asset. But in this case, we have two exemptions, or basically two instances or two circumstances whereby the lessee is exempted from recognizing those two items in his books of account. So mean that at a number of circumstances, the lessee is not required to recognize the right of use asset in his books of account, and what if there is liability. So which are those exemptions? Which are those exemptions? Exceptions. So basically we refer to them as exemptions or exceptions from complying with IFRS 16 as far as accounting for leases by the lessee is concerned. One of the exception is in case of what we refer as the short-term lease. The short-term lease. Remember, we defined what is a short-term lease, and we say that these are lease whose lease term does not exceed 1 year or does not exceed 12 months. So whenever a company leases an asset and the company has leased that particular asset for a period which is less than 1 year, that company do not necessarily need to recognize the right of use asset and also the lease liability in its books of account. So such a company will just account for the rent which was paid as an expense in the income statement. Number two, or the other exception, is in case of what we refer as a lease of an asset, of low value, and a good example of this is a lease of a personal computer, So if a company leases such an asset, e.g. a personal computer or even a laptop, which is of low value, that company do not need to recognize the right of use asset and the lease liability, but the company will just need to recognize the amount which is being paid as a result of having leased that particular asset as an expense, as an ordinary expense. So therefore, those are the two exemptions, or basically the two instances, two circumstances whereby the lessee is not required to fully comply with the requirement of IFRS 16 as far as the accounting for leases are concerned. So therefore, that what you need to know as far as the accounting for leases by the lessee is concerned. I want us we take a short break, and then once we come back in our next class, I want us we look on an illustration regarding accounting for leases by the lessee. And then once we do that particular illustration, we are going to proceed and look on how we account for leases by the other party, and that is the owner of the asset or the lessor. So therefore, we take a short break, and then we meet in our next class.